Hello, welcome. Let's get right into this. Let's start with the positions we opened at the beginning of this session. We sold puts, 30 delta puts, 105 strike delta puts on 105 strike puts on DHI. The idea here is very simple. We like the sector, we like the company, we like the how it plays into our macro view. We don't expect any negative catalysts coming in our way in the next 2 weeks until we get the until 1st of July. Debt ceiling resolution, and all that thing that will cause some volatility undoubtedly. But so far, on the macro side of the equation, because when you sell, for our macro idea is for broader consolidation in the whole equity universe. And when we sell options, we sold 32 days out. We have to manage it at 21 days. So we have plenty of times for that. We're just looking to pick up that theta decay. That's it. Broadly, we are looking to create and find the opportunities to create income factories, any income generating strategies on across our equity spectre, because we have this view of race, we have this view where we are in the sine curve, we are clearly in a slowdown, waiting for the contraction, and contraction is probably will be swift because of the credit crunch. We don't know where this is going to happen, when this is going to happen, but it will happen. So but we like the company, we like the sector, we like the factor, we like the signal, and that's it. We just sold puts just simply for income. How we're gonna manage this one? If let's see what happens after this week. We're gonna close it at 50% max profit. If it goes down and tests our strike, we're probably gonna roll this down once and see if it holds the trade and transport, and then work our way from this one. Another position we opened is TLT. TLT is obviously long end ETF. Signal implies consolidation. This week we have almost every single day we have different Fed speakers come out. Fed where is it? Economic calendars. We have Fed chair this Friday, Fed Williams, Fed Jefferson, Barr. Somebody on Wednesday, right? No, nobody on Wednesday. But a lot of Fed speak we have this week. It should probably generate some volatility in the rate space, but the whole rate environment is signaling consolidation. Once again, nothing is broken. They're not gonna pivot. Right now, let me open up this better Fed funds futures to show this one. Probabilities. Where is it? No, that's not this one. Fed funds futures. Our broad expectation for this week and the setup we are observing in the rate space based on our signal is for the flattening of the curve once again. Essentially, what we had in the 2-year yield and market expectation is a massive repricing of rates lower because of the stresses in the banking system. It has been dealt with. Inflation is, in some instances, even accelerated the core metrics that Federal Reserve looks at. So this week we expect with all of the Fed speak we expect curve flattening, a small flattening of the curve, and this will be reflected in TLT as a consolidation, negative consolidation with the consolidation with negative downward sloping, with downward slope. Essentially, this is what it looks right now. Nothing as of this moment can shake us off this equilibrium. Nothing that's on the table. So this is the idea. So what did we do? We sold the strangle. It was incredibly cheap. We sold 106th strike and 99th, 106 call and 99 put, essentially skewed strangle. Our expectations to the downside. We didn't want to sell the call on its own. The ROI on this position is 24%, which is good, which is incredible. We expect consolidation, continuous consolidation, at least with this week. So let's see what happens. We definitely skewed. Our opinion is to the downside. Our opinion that we are going to see rates reprice higher once again, not to the large degree and to the large extent that we've seen it reprice right here, but nonetheless, the risk here is to the upside. In our view, same thing with 10-year yield, same thing with 30-year yield. Obviously, that's why we sold the put so much closer to the at the money that we sold the call so much closer to the at the money that we did the put. The put is 18 delta and the call is 38 delta. That's 20 delta. That's 20 delta negative position on TLT, and the ROI is very good. The efficiency ratio is not that great. The gamma to the theta decay is 12 to 8 or 12 to 6. So essentially 1.5 efficiency ratio, but we are content with this position. How are we going to roll this one? How are we going to manage this with this if we get it? In our view, obviously, first of all, we look at the signal. In our view, if a signal is pointing to the downside, if we do get a meaningful repricing of rates lower, rates higher, meaningful TLT lower, which we do not expect. We do not expect that. But if we do get that, we're simply going to roll the put lower at 104, closer, maybe from 106 to 104. We take the position right here and roll it to 104, roll the untested side, and see what happens after that. These are the positions we took. Now, these are the positions that the best reflect what is happening with our view, macro view, right now. So rates is signaling, once again, signaling consolidation. We are not seeing any signals of meaningful events that can shift us off from this equilibrium. Now we're gonna see. That's the idea. Rates consolidation with upward tendency across the short end and across the long end as well. Same thing goes for Europe. Once again, regarding Europe, the signal is for the 2-year yield and the long end and the 10-year yield in Europe has broken trend and broken trade, which is surprising. Essentially, the difference, once again, as we highlighted in previous videos, this difference in the rate expectations between Europe and the US allowed the DXY, allowed the dollar to reprice lower, as we've seen right here. This move, essentially the market expectation of rates lower in the US at the higher pace than in Europe, and at the same time in Europe they had expectation of rates going higher because inflation there is much more sticky and lagging before the US, after the US. We've gotten this move in dollar. Our call since the beginning of this year has been for consolidation across all major asset classes. An incredibly hard environment to navigate through, but this is what we're getting. Essential consolidation. Dollar has broken to the bullish trend and bullish trade. We look to be long of the dollar at this point. This is how our rates view translates into the currency situations, currency positions. Be long of the dollar right now. And if this tendency continues, and it will probably continue because they're not going to cut rates, and imagine a market is setting up to the interesting opportunity right now. Let's leave this negative catalyst that is looming, is debt ceiling. Let's leave it aside for a moment and let's see what is happening with the Fed policy right now. The probability for the Fed hike, another 25 basis point Fed hike next month, which will happen. Fed meeting, next meeting is 31 days out. It has the probability of another rate hike, 25 basis point hike is 18%, minuscule probability. Even though inflation, the core metrics that they look at, has accelerated. Unemployment is at the 3.4%, and nothing so far, nothing is signaling that they shall stop the rate hikes. I'm not talking about pausing or even reversing rate hikes or even cutting. I'm talking about stopping rate hikes. Why wouldn't they go another 25 just to hit the nail on the head and get the job done? Why wouldn't they? And the probability of that in the markets, in the eyes of the market, is 18%. Only 18%. Maybe it's going to shift higher after this week Fed speeches that we're going to get, which is a lot of them. And imagine if they are going to hike, with the probability of it being 18%, if they're going to hike another 25 basis points, we're going to see dollar rip. We're going to see dollar rip. We're going to see rates rip. We're going to see another good repricing of rates higher. We're going to see dollar lower. We're going to see oil lower. We're going to see dollar higher. We're going to see gold lower. Essentially the same old trade that we've been observing, and TLT lower. So this is hence our position, but it's still 31 days away ahead of us. So this is the interesting potential setup that the market is sniffing out right now. The price of the market, not the probabilities that we see on Fed tools, but the price action in the market. Be long of the dollar. Not be long of the dollar. Once again, we are in a consolidation, in a broad consolidation, and we do not expect this consolidation to end. So, generate any income generating strategies that you can, because expecting a meaningful shift from this equilibrium, we've been trying to put some of those trades. They did not work. Usually, once again, how this works. We have broader consolidation across all of them asset classes, and you expect that some of these movements will continue higher. We have this repricing, either lower or higher. Or right here, you can set up for break this downside, and it looks like it's going to break. It looks like it's going to break out or break down, and it doesn't. And it doesn't. It just shifts. It can shift to a lower equilibrium and stay here. It can shift to the higher equilibrium. It can stay in the range once again. So be very mindful of it. Nothing in the macro space so far suggesting the imminent repricing of things in any of the directions. We are certain that it will happen at some point, meaning the credit crunch will happen at some point because of the higher rates, especially these sticky higher rates, especially if they're going to hike another 25 basis points and the market expectation is going to reprice higher. This will weigh in on the credit area of the economy once again, because so much debt has been taken on during the period of negative or zero rates that so much things has to reprice, and they've been repricing and rolling their debt at 2-3%. Now they have to roll at 5.5, 6%. This is 100 basis points, 100% increase in your payment ratio. So somebody's gonna take a hit. Somebody somewhere gonna take a hit, and this will trickle through to the credit availability and probably hopefully to the markets itself. So the dollar is and currencies is a reflection of the policy. Right now we're consolidation with the policy positively sloping. Positively sloping consolidation in the dollar. Same thing with negative Europe, negatively sloping consolidation in euro, and such currencies as Aussie dollar and KD, CAD, Canadian. These guys that are heavily related to the commodity prices, they have been in consolidation, and they will continue to be in consolidation. The commodity complex is signaling oil in the biggest of the bunch is signaling is not once again negative trends, so nothing to do here. If you want to short it, I wouldn't be short at this point right now of the cycle. We're just gonna see these things continue to happen unless something exogenous or endogenous happens. Gold reflection of the price of the rates and of the dollar. And looking at the other things that are closely correlated to the gold is silver. Silver has already broken its trend, and platinum is testing its trend support right now. So if we're gonna see a repricing of rates higher, as we expected, gold is testing its trade. I think we might see gold testing its trend once again right here. We would be a very eager buyers of gold at this point, selling puts, meaning so gold is staying positive despite the negative signals across the related complex. Gold is staying surprisingly resilient, which we do like, and we're looking to sell more puts on gold, especially if it gets closer to 1970, and especially if we're going to get this repricing that we talk about in rates, we're going to buy more gold. World dollar, crypto. Crypto is in this phase. Let me point this out. Just to the similarities is uncanny, but just to point out, to explain to people, because people like to put something in relation, reference, in comparison to something. We somewhere in this stage, probably in this stage, in this prolonged consolidation. This is supported by the macro state of things, so I would not expect crypto to break down or break up meaningfully unless SPY does so. And yeah, once we get to SPY, we will outline the possible scenarios right there. But right now is signaling consolidation. It's bullish trend, bearish trade, and we do expect something like this to continue, maybe in this range. And eventually, if this debt ceiling passes and everything is honky-dory, is all right, and the sentiment picks up again, then we might see SPY repricing even higher, and we will see Bitcoin creeping up with the SPY as well, and probably retesting 36,000. But not at this point. Not at this point, definitely. Commodities. Copper. We've been highlighting this correlation between copper, between HSI, and between Chinese currency. And it's this similar setup generated in a nice short that we've pointed out. Copper is, despite the long-term cycle and the preferable supply and demand dynamics, is representative of the health of the economy, health of the industrial side of the economy. There is no demand. There is simply no demand, despite of this secular bull case for copper, and we are in these conditions. Everything in commodities points out to this. So we are in clear slowdown, and we've been in this slowdown phase for a while now, and we're just waiting for this credit crunch to happen. This might happen this month, might happen 2 months, 3 months, 5 months, maybe a couple of quarters, in a couple of quarters. Who knows? But we have to be put on these income generating strategies that profits if we stay in consolidation. Belong of the equities that we like, belong of the equities that large cap, value, defensives, and the other factors that we like Visas, Mastercards of the world, Walmarts, and all of those guys. So it's quite boring market right now. Rates, we've been through rates. High yield, credit, same thing here. Nothing is happening. Look at this month. Look at the last 2 months. We've been in such a tight range, and I don't see anything that can shoot us from this tight range, at least this week. So nothing to see here. No clear signal. Yes, if we're gonna see a high yield breaking down 74, this guy usually leads the SPY, leads the equity, and if it does so, then we're gonna position accordingly. Maybe reduce our dollar-weighted delta a little bit, pick up some short delta. But right now we are in consolidation. We are in the range, and we'll continue to be in the range. LQD, this guy that is anti-correlated to the rates, signaling the same thing: bearish trend, bearish trades, and consolidation with a downward sloping curve. So nothing, absolutely nothing in here. And SPY at the same time has been staying in consolidation for a while right now. No idea, absolutely no idea. We've been once again selling. We're not touching the SPY right now, nor are we. Let me point out something that is of value. Is the small cap. Small cap and the micro caps. What's this? Micro cap, IWC and IWM. These guys have been much more volatile and producing much more coherent signals, and they've been pointing out to the potential repricing higher. This is a potential creation of a daily high low. Now we'll possibly break 175, and if we do break 175, we're going to retest 180. So this is a positive signal for the overall market. If the guys like IWM and IWC that are leading the market break in trade to the upside, that means that the SPY has much more. This means that nothing bad is on the horizon at this point, in the immediate future. So this is also good. And this is what's happening right now. It's potentially creating daily high low right now in front of our eyes. Same thing with the IWC. It has already created a daily high low. So this is a positive signal for the overall market, which is just coherent with the call of consolidation, upward sloping consolidation. Same thing with the SPY, same thing with the IWM, QQQ, same thing with QQQ. XLY, consumer staples. If we are calling for the recession, and guys like XLY, Tesla is signaling bearish trade, but Amazon, which is 24% of the XLY, is signaling bullish trend, bullish trade right now. This is one of the reasons why XLY is bullish trend, bullish trade. So no imminent danger in the equity market at this point. Definitely nothing like that. But we do like XLP more. We don't like XLU. Why? Because, well, very sensitive to the rates. One of the components of the rate sensitivity. These guys, if rates, we're going to see repricing or rates higher, which we are calling for. This guy is going to do this stuff. He's going to stay in consolidation once again, but in downward sloping consolidation. So be mindful of that. On the other hand, XLP is very preferable. We do like XLP very much. Maybe not the whole, you can play it with ETF, but we like different companies like Walmart and Costco that hasn't reported earnings yet, but they're gonna all of their other competitors, they have reported the inflated earnings due to the inflation, and we expect repricing of those names higher, Walmart and Costco in particular. XLV is interesting, but once again, different components of that name. ITB and XHB is also of interest. DHI is a representation of ITB, the biggest name in home building construction sector. We've sold puts as we outlined. SXXB Europe signaling bullish trend, bullish trade. Nothing impacts Europe at this point. In the rest of the world region, Mexico, we've been highlighting the long Mexico call, and it's playing out very nicely. So essentially, this is in dollar. ETF is in dollars. So this is what we are seeing right now. SPY is in consolidation, and Mexico is producing you 573, 6% returns while the SPY is in consolidation. So very nice relative play, and we continue to be long of this name. And that's it. As to the rest of the world, we don't have any positions. China, once again, in consolidation, it's testing trend, testing trade, but we have taken out just now yesterday we've taken out the trend, and it's now signaling bullish trend, bullish trade. We've been short. Our call been for this short move on the HSI. Right now we're expecting HSI to reach 20,300 and maybe retest 21,000 on the index, meaning higher. Flows shifted to the upside. Right, the last time we called for short, it has been after we've breached this important level right here, and if you would have entered right here on the any retracement, we've produced this nice run on liquidity right here. Right now we've taken all the liquidity and potential. We see a creation of a weekly high low, which will lead us into the 21,000 region. So EWH is of interest to us, FXI is also of interest to us. In terms of the other names, relative names, we haven't been through them yet. We'll point out that something changes on that front. So Walmart, long Visa, long MasterCard, and that's it. As of now, that's it. The Nvidia, also interesting, continues to be an interesting long, and will continue to go to grind higher. Will continue to be a relative outperformer in the world where everything is consolidation, but it has an amazing sentiment because of the AI stuff, and will continue to grind higher slowly until the macro changes or the internals of the company point out to the fact that AI so far hasn't been reflected in the prices. It has been reflected in the earnings. And earnings come out on Wednesday 24th. And AVGO is another interesting name that is of interest to us. We've been selling puts on this name as well. And we shall end this right here. Yes.